What do you think people should be nibbling on here?
I think there are very few truly defensive names in large cap internet, but if you're looking for them, I think they are Netflix, Amazon, Akamai, Spotify, and even if you go down cap a little bit, Chewy. I think every other company that we cover has already seen material earnings cuts and revenue cuts, and I would expect more to come.
Yeah, that said, as worse as it gets, you wonder if it's overdone. And I know you said on that point, maybe both Uber and Lyft are in that territory. How would you kind of find bottom for those companies? And how do you start thinking about the rebound?
Oh, I think that there's some very interesting places. I think there's stocks that I strongly believe are oversold. Now, when they actually start basing out is when the estimates base out. We've seen contractions in demand for Uber and Lyft much greater than we thought, and it's a moving target. Just within the space of 3 days last week, the company saw demand in Seattle go from down 40 to 50% to down 60 to 70%. That was in 3 days. So I don't know when things get less worse, but when they do, I would think some of these companies snap back fundamentally very quickly, and their stocks will as well. And I think Uber is probably the single best example of that. You'll see people whenever we get out of lockdown, whenever we get out of shelter in place, people are going to start commuting again. That means Uber's demand is going to surge, and the amount of supply that's going to be out there in the market for really all of these gig economy companies is going to be very large, unfortunately, but it means it's better for their businesses. You'll see fundamentals in stocks snap back quickly.
Yeah, and Mark, we like to ask you about valuations, and it seems to me like that conversation and that question has taken on an entirely different light going forward. If you're not talking about just the next quarter, even if you're not just talking about 2020, what do you think should be the mindset of the investor investing in internet stocks for the 3 to 5 year time frame? What can they be sure of? What should they be betting on? What should they believe fundamentally?
I think you start with the most risk-averse mentality. Where is there the least liquidity risk? And, this is very different when the sector was, 10 years ago during that great financial crisis. I mean, the balance sheets at names like Google and Facebook are about as bulletproof as you can find anywhere in the market. I think Amazon's actually pretty close. So I think you can start with those names. Also, the valuations intrinsically, now estimates probably have to keep dropping, but the valuations here are far from stretched on names like Google and Facebook. Those should be good core longs. Then I want to switch and have you think about, we're going through a massive disruption in consumer behavior. Which companies are going to benefit from those changes in consumer behavior? We see an inflection point in demand for things like food delivery online, meal delivery online, consumer staples purchases online, and grocery shopping online. I think Amazon is fundamentally going to benefit from those trends. So you got a company with a rock-solid balance sheet that's probably going to benefit in terms of the consumer behavior, permanent consumer behavior shift because of this environment. Amazon should be a clear long-term winner.
Yeah, and then, of course, Amazon has Whole Foods as well, which, at least from my own personal experience, has been pretty darn busy in recent weeks, too. Mark, I'm curious about the cuts we're seeing in advertising spending right now. We've got Twitter saying that ad sales have been hit by coronavirus and withdrawing its first quarter revenue outlook and forecast. You make the point in your note that some of the largest Internet ad spenders are, in fact, other Internet companies. Break this down for me.
Yeah, so we, I think, had a very clear, I don't know if it's a clearing of the decks data point last night or not. I hope it is, but we may still get worse. So Twitter essentially told us last night that their ad revenue in the month of March was down something on the order of 15, 20, maybe even 25%. Almost with certainty, we should all believe it's going to get worse in April. So you're talking about a company that generates about $3 billion in Internet advertising globally. So this is a pretty large data point saying you should expect, or I'm interpreting them as saying you should expect their ad revenue globally to be down 30%, maybe more in the June quarter. That's much more severe than we saw any of the Internet advertising names suffer during the great financial crisis. So it just says something about how severe the contraction is. And this is for a company that's, by the way, seeing a surge in demand. A surge in usage and engagement. More people are turning to social media. Twitter reported an acceleration in users. So it's not a user problem. it's not a consumer problem. Advertisers have just stopped spending online and in every other channel. Just flat out, they've stopped spending. That's how severe this fee is going to be.